The Fed's tools to manage inflation are almost entirely geared around bank lending. Bank lending and exchange rates, basically. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything. Interest rates are not the strongest lever to control inflation when you have fiscal dominance.
All right, welcome back to another episode of On the Margin. And joining me today is renowned repeat guest, Lyn Alden. Lyn, it's always great to have you on the show. How are you doing?
Always good to be here. I'm well.
Glad to hear. Okay, well, let's start from the top line. I'd love to just hear, we're halfway through January here of the new year. Would love to just think and hear about how you're thinking about your global macro outlook for 2025, just from the top line, and then we'll dive in.
Well, to start off with, we have the same momentum that we had in 2024 and really much of 2023 for that matter, which is decent liquidity conditions and ongoing fiscal dominance in the US, which is leading a lot of things to run hot, ranging from nominal GDP to asset prices. Um, and a couple of the key things I'm watching for 2025 is basically anything that would change the course of that or give us some wiggles along that path. Um, and so one of the things I'm watching first and foremost is the debt ceiling issue. Um, Not because I expect much out of it in the long run in terms of all the defaults and stuff that can happen, but rather because when the debt ceiling's being contested, the Treasury has to do extraordinary measures, which they started this week, and that basically means that they have to drain cash from their account back into the system in order to keep paying their bills without issuing that new debt. So the longer that goes on, that's a liquidity factor, which can then translate into asset prices and other things like that, financial conditions broadly. And then also the one of the biggest things to watch is tariffs. That's potentially an all year thing to watch, but especially in the first few weeks and months here, to see any sort of announcements around that. So I get a lot of questions around what's the Fed going to do. Obviously have an upcoming Fed meeting, but in this era of fiscal dominance, I pay a lot more attention to some of these other factors, even though, of course, Fed decisions still matter. But at the end of the day, fiscal matters a lot more.
Yeah, that's a great high level outlook. Okay, well let's dive into these specific liquidity factors. So you mentioned the debt ceiling situation, and I totally agree. Being actually worried about I don't know like a debt default is kind of ridiculous, but there is some really interesting insights in terms of how that potentially impacts liquidity conditions. So as you mentioned, these extraordinary measures have started to be executed now, and that's sort of the first step where they cut these very specific costs that they could do underneath their mandate. And then once that runs out, then they can start to drain the TGA account, which I believe is sitting at about $600 billion right now. So there's basically this potential tailwind where that can basically be drained out into broad markets. And I'm curious, first off, I want to hear about that. And then also what we're hearing in terms of maybe some of these more monetary plumbing liquidity impacts, such as the reverse repo, which is like sub $100 billion now, and what's going on there. But first off, on the TGA part, I don't know if you've looked too deeply into the potential outcomes of how long this game can be played on. Obviously, we have a House and a Senate that are both Republican. So even the fact that we're debating debt ceiling is quite interesting to me. So I'd love to just hear first, how long do you think this takes on, and how deeply have you looked into the specific factors of why we're even having this debate?
Well, so historically, I mean, the debt ceiling was not used for a negotiation tool for most of its life. Ever since the global financial crisis, it started to be used more. We have a fairly small sample size of presidents since then, and most of those president terms have been Democratic presidents. And so it's mostly a tool that Republicans use against Democratic presidents. We didn't really see Democrats use it against Trump in his first term. And now we might see Republicans use it against Trump. But to answer your question, my base case would be to see not very long because of the fact that it's all intra-party, and he's got a very strong position within his party, kind of culturally, and in terms of allies. So um, if this were to go on, kind of as the 2023 debt ceiling did, and then I believe the 2021 debt ceiling. It could potentially go 5 months or so, kind of, be a dominant factor for much of the first half of the year and drain that 600 billion plus back into the system over the course of the better part of half a year. That's basically if you leave it as it is now, no ability to lift the debt ceiling, ongoing disputes, and then they have an 11th hour fix to it like they've done prior. That's kind of what would happen. But I expect it to get handled more quickly than that because of the fact that it's all intra-party. So it's something that I don't think all that liquidity is going to get drained in the system, but until we see progress on the debt ceiling, the TGA will start, gradually draining back in.
And then on the other side of the equation of this liquidity situation is, as I mentioned, the reverse repo and just overall monetary plumbing dynamics. We've seen there's some increased concern from the New York Fed at the end of year. There's the annual window dressing that occurs, and that's often a time where we can see if there's going to be strain on bank reserve liquidity. It often shows up there. So they came in and preemptively brought up like additional standing repo facility availability and that sort of thing. So it feels like we're getting to this point as well on that side of things where we're starting to reach those bank reserve levels where we might to see strain. Is that how you're thinking about it?
It is, yes. So if you back up a little bit, back in 2022, that was a very negative liquidity year. The Fed was draining liquidity, and also the Treasury was not really providing liquidity. But ever since we saw the issues in 2023, partially around regional banks, but then also the rising yields and things like that, we started to see the Treasury increase its issuance of T-bills, and that allowed them to suck liquidity out of reverse repos and back into the system. And so, really, for about 2 years, we've seen the Treasury almost perfectly offset the Fed in terms of liquidity. So the Fed's still doing quantitative tightening, but the reverse repo facility is draining back into the system at almost exactly the same pace. Um, and so when you kind of look at aggregate measures of domestic liquidity, it's been almost perfectly flat. It just kind of trends sideways ever since 2023. But that's got a time limit to it, which is there's only so much left in the reverse repo facility for that to happen. And the last 2 quarters, we have seen increasing amounts of kind of strain under the surface. So the repo facility was tapped in quarter 3, window dressing, and then it wasn't really tapped in quarter 4, but we saw kind of initial funding stress leading up to it. Basically, it was expensive for different institutions to get the liquidity they needed during window dressing. If we take the TGA out for a second, we probably should expect that by mid-year or so, we run into some, pretty serious liquidity constraints in the system. We'll get kind of updates probably each quarter to see what does funding stress look like. Did anyone have to tap the repo facility, the Fed's repo facility, and things like that? But yeah, most indicators show that we're kind of pretty close to the liquidity floor in banks. Um, and the Fed's probably going to go back to, not doing quantitative tightening this year at some point and either have a flat balance sheet for a little while or go back up to kind of gradually increasing their balance sheet, only in terms of treasuries, while probably continuing to let off mortgage-backed securities from their balance sheet. And if you bring back in the TGA for a second, that could extend the current situation a little bit if the TGA does end up draining entirely into the system. And then you'd have issues when they go back to refill it. Now, still not my base case that it's going to be drained, but that's more of a political question. So that kind of does throw a curveball into things for the first half of the year. But either way, by the second half of the year, we're probably going to see liquidity constraints in the system.
Yeah, it sort of feels like regardless, a lot of these levers have already been pulled, and we're getting to the end of the road a little bit. You mentioned earlier in there about how Treasury Under Secretary Yellen has basically kept things afloat by prioritizing bills issuance over coupon issuance. So now we obviously have Scott Besson coming in as the Treasury Secretary, and he's been a huge critic of that approach of prioritizing bills and weighing it. So he's come in here, and before he got nominated, he's been on the round circuits of podcasts, et cetera, and he's been talking about how we got to get to a point of a more sustainable fiscal path, and that includes prioritizing issuing on the longer end of bond yields, so more coupons. How do you think about that likelihood? Do you feel like that's something that's actually going to be happening, or once he gets in the chair and sees the risks that are posing, he relents and moves back towards bill issuance, or is he going to be steadfast? And what would that do to bond yields?
Well, so that's another big thing I'm watching. Is he going to follow through with his duration increase? Um, if I imagine a scenario where he's successful in that, he could try to force it, and when those liquidity issues start materializing, it could be that the Fed is the one that has to back down and end their quantitative tightening and go back to very gradual balance sheet increases and basically say we're doing this for minimum reserves in the system and market functioning and plumbing issues. Not they wouldn't really do it for stimulus per se, but they would do it, just maintain liquidity. That's a whole, challenge we might see between the Trump administration and Powell. With Powell's remarks about how he can't be forced to leave. During Trump's prior term, he was sometimes critical of hawkishness out of Powell, and so instead of rates, we could see a debate over liquidity, essentially balance sheet size, and the Fed kind of offsetting some of that duration issuance. Without Fed support, the risk is that as they try to increase duration, that would suck liquidity out of the system, and that potentially threatens asset prices. And even compared to most other, I mean, all presidents care about the stock market and asset prices, but Trump especially looks at those. And so if it kind of persists long enough, you could get Trump weighing in on that. You could get interaction between the administration and the Fed. So I certainly think it's worth watching. But I think that if I back up and say, regardless of this election outcome, how it ended up going. Even last year, I was saying that I think in 2025, the Fed's going to end their quantitative tightening and go back up to either neutral to upward on their balance sheet. Um, and this changes the personalities involved when that happens and the potential paths that could happen on. But I think that's somewhat inevitable. And so that's one way that they can potentially increase duration without a major liquidity problem is that the Fed adds a little bit of
Hmm.
liquidity.
Some might say that nothing stops this train.
Yeah, I think so, especially when you have a fiscal authority and a central bank go head to head. It's rarely the fiscal authority that backs down, especially given how entrenched this all is in the U.S. um, and how kind of the financialization of the economy and the sheer kind of entrenchment of those deficits.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today. Okay, so I want to deep dive on something you've been writing a lot about, which is really just this tension between what we've seen on the monetary policy side of things, which is increased, Fed funds rate, and then recently, we've had 100 bips of cuts so far, and comparing that to what we see on the longer duration end of the economy. So, 30-year mortgage rates are at 7% right now, at the same time that we've seen a decrease in the Fed funds rate. And the way you characterize this is that because of the proportion of house owners that are in 30-year fixed rate mortgages, their obligations have remained low at the same time that they're, if they're asset owners and they have a bunch of money in money market funds, et cetera, they've seen their passive income go from 0% to 5% and now down 100 bips, but still pretty good. So I want to ask, how are you thinking about that tension between basically the short rate income versus the long bond yield obligations? And obviously those have been increasing in recent months. We've seen, the 10-year bond yield go up by 100 basis points. So how are you thinking about that tension today?
So I think it's partially why there's a disconnect between kind of the wealthy and the less wealthy, or the asset owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now. Um, and now that I kind of view it as range bound. So during the rapid increase in interest rates, this was a really powerful effect that was happening. Now I think it's kind of absorbed. We've seen, banks have kind of absorbed a lot of the initial unrealized losses they had. We have some of the really problematic ones got cleared out, but now it's just kind of slowly being absorbed into bank capital. And then also, I think the same thing's kind of happening on balance sheets around, which is that now it's kind of range bound, so it's less of a kind of a fast hitting factor and more of this background thing that's happening. And that's also why I categorize rate changes as so relatively inconsequential compared to other things because one, it's fiscal dominance rather than monetary dominance. So whether or not you get extra several $100 billion in deficit spending or not is a much bigger impact than a few basis points. But then also the Fed cutting the short end doesn't necessarily translate to similar moves on the long end, which is where a lot of businesses and consumers are actually borrowing from in terms of new loan origination. It also this kind of point to the kind of ineffectuality of the Fed here because if you just kind of back up and say the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. So if they raise rates, the goal is to kind of slow down bank lending, make borrowing more expensive, and also to harden your currency compared to potential foreign currency, so foreigners don't pull money out of your economy. So those are kind of the two levers. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything against monetized fiscal deficits. Now, they can push back on monetizing it to some degree. But at the end of the day, if they see dysfunction in the Treasury market, they always step in to fix it. Um, and so their tools are not really geared around that. And that's why it's ultimately more of a fiscal thing. Now, the Fed they can kind of indirectly tackle that by saying, well, if fiscal's running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is normally at X, we can slow that down to maybe run at 70% of X. So you have a little bit sluggish bank lending and therefore slow down money creation that way. But then all you really do is shift where where the driver of the economy is. You're almost kind of like unfairly slowing something down because fiscal's running hot. And so that's kind of the big challenge that they face. Um, and it just kind of shows that the whole model doesn't work as well as it's kind of intended to when you have fiscal dominance, which is why this period is kind of just structurally we need different ways of thinking about it compared to how we analyze markets for much of the kind of the past 40, 50 years.
Has your outlook on the fiscal situation changed with the new administration, or has it been largely, a lot of these, like I mentioned earlier, this nothing stops this train thing. Like there's a lot of these factors that feel like they're just built in and sort of inevitable. So I'm curious, as we head into this year, what is that fiscal outlook, and has it changed significantly now that we have Trump instead of Biden in the administration?
So I think it changed minimal. I think a lot of this is entrenched. A lot of this is demographics. A lot of the Social Security, the Medicare stuff is demographics. The very high healthcare spending has been an ongoing problem. Both private sector and public sector spending in the U.S. is our healthcare per capita is the highest in the world without really good outcomes to show for it. Defense is all sorts of geopolitical issues, but also tons of fat that they could cut out, but is very entrenched. I think the main moving parts there are if we had gotten a Harris victory, then we would have had to more seriously consider some of those Trump era tax cuts expiring, going back into effect, which would have been effectively a tax increase. Now, because we get the Trump victory, those are less likely to be allowed to go back in. They're more likely to be either extended or made permanent in some fashion. And so that's basically all else being equal, a deficit contributor. But then on the other hand, now we have to seriously consider tariffs to some degree. And those are tricky because to what extent are they taxes on the American people versus taxes on foreign businesses? The proponents of tariffs would like to say that it's going to come out of the profit margins of the foreign producer. But a lot of, especially physical goods, a lot of profit margins are 10, 20, 30%. So if you put 20% tariffs on someone, they're either gonna not sell to that market or they're probably gonna increase prices to some degree. Um, and so we could see additional revenue from I believe they call it the external revenue service. Um, so that could balance it out. I still think tariffs are one of the biggest things to watch because we don't know the magnitude yet. We've seen kind of the opening statements, kind of what the initial side of the negotiation, but where do those actually land in practice? Really remains to be seen. I generally would take the under, just because I think it's an administration that'll be very careful of market disruptions that are abrupt, but we'll see. Um, and in general, there's a lot of emphasis put on how many workers are in the federal government. We can always there's always like programs you can point to that are incredibly wasteful. $1 billion to save this like rare type of trout in someplace. Like there's always things like that, and you can get a lot of optical victory by like trimming some of those. But the major areas of spending are Social Security, Medicare, interest expense, DoD, veterans benefits, and that type of stuff. And the GOP had it in their 2024 platform. I believe it was Promise 14 to not cut Medicare or Social Security or raise the retirement age. So this is not the Paul Ryan era of the Republican Party. This is a little bit more of like kind of socially conservative, but fiscally more moderate kind of Republican Party that we see, because that's a very strong voter base is people that receive those benefits. So a lot of that is locked in very, very kind of the third rail to go after. Interest expense is obviously very hard to go after. DoD is a potentially big area to cut. Um, but every one of those programs is going to have whatever congressperson has that in their district fighting for it. And so I think that they could get some optical wins there, but we're talking tens or potentially 100 billion in a deficit that's, bordering on 2 trillion. So I think in terms of big numbers, my deficit view is largely unchanged, but I continue to monitor any sort of legislation that pops up.
Yeah, it's funny. You mentioned this idea of these optical wins versus like substantive wins, and I think about it's funny. I interviewed Warren Mosler actually a couple of months ago, and his whole thing is like, look, if you want to actually control the deficit, the easiest and most substantive thing you can do is just cut the Fed funds to 0%, and suddenly your interest expense is negligible. Do you think anybody seriously think about that? Obviously, that's attributed to the fact that he thinks it's not inflationary to do that. But I'm just curious, like, how do you think about such a aggressive idea as that?
Well, there's a couple parts there. One is that would I mean, there's Fed independence to some degree, right? So that's a Fed decision, not a fiscal decision. Uh, and generally speaking, when if the fiscal authority has direct control of the Fed, that's usually not a monetary situation you want to see. But if they were to do it, if the Fed were to decide to do it, there'd be a couple things. One is you probably would have a substantially weaker dollar, and therefore you'd probably have substantially higher energy prices. So you'd probably get a burst of inflation from that. But then you would notably cut the deficit. You would, cut the interest expense over time. It would take a while to play out because some of that is locked in for several months or a few years. But that would start to rotate back down. We probably would see. It's unclear what would happen on the long end if the market was spooked by it, that we might not see that translate into more bank lending. And you could end up with a situation like Japan. I mean, part of why Japan, they had some of the slowest. Everybody talks about Japan as like a money printer, but they actually had like the slowest money supply growth from the year 2000 to the present among major currency blocks. And there's a couple reasons for that. Like, their central bank balance sheet went vertical, but their broad money supply was actually very slow growing. And there's a couple reasons. One, there was private sector debt reduction, which when you pay off a loan, you destroy broad money, and that was offset by monetized fiscal deficits. So basically, if you're doing 5% a year fiscal debt monetized fiscal deficits, and then you're reducing corporate and private debt by 2% a year, you're left with like 3% net growth, which is low. Um, and so that's kind of the situation Japan went through. Um, it's harder in the US because we're running structural trade deficits. So our currency, could, you know, have more issue with kind of perpetually zero rates when other major currency blocks are not at zero. Um, the funny thing is it would then probably allow other big currency blocks to cut their interest rates, maybe not to zero, but they could lower them a lot because their biggest benchmark comparison is now eased. And therefore you could get, for example, a boom among the BRICS countries. Like right now, Brazil is running fiscally hot like the US, but they don't have the world reserve currency, so they're actually pressured by it. Um, and their central bank is keeping rates really high to kind of keep a lid on that. But if the dollar was cut to zero, um, the Brazilian central bank could probably ease, and that'd probably give a little bit of a boom in Brazil, which would then compete for things like oil and commodities, and probably give us some inflationary pressures. So the part where I would agree with him is that interest rates are not the strongest lever to control inflation when you have fiscal dominance, because you raising rates does slow down bank lending a little bit, but it also blows out the fiscal deficit by literally a bigger number. Um, and so it's kind of a mixed bag. Um, and so I'm kind of neutral on that whole thing. The biggest levers for inflation and this whole thing is energy abundant? Is trade flowing well? Are there any clear bottlenecks that can be addressed? And then what is the overall size of the fiscal deficit? And so yeah, I think there is merit to that. Um, I think if when you look at a country that's even further in fiscal dominance, like Japan, um, you can get to an argument where interest rate increases are actually pro-inflationary directly, but because the U.S. is kind of teetering on fiscal dominance, interest rate increases probably have a somewhat neutral effect, which is to say that you do slow down bank lending and you do increase the fiscal deficit by roughly similar amounts. Whereas in Japan, bank lending is super sluggish and debt to GDP is even higher. So every, 100 basis point interest rate increase would have an even bigger ratio of deficit increase versus bank lending slowdown.
Yeah, to your point, the most durable way to get inflation lower, other than these funny tricks, is just energy abundance and lowering the cost of energy. And I'm curious, how are you thinking about the Trump administration's outlook on energy? Obviously, they want to just unlock and drill, baby, drill. Scott Besson has mentioned that he has like his 3-3-3 approach, and one of those is unlocking 3 million barrels a day of additional oil, and they also want to refill the strategic petroleum reserve. So there's a lot of energy focus and energy independence. And I'm curious, how are you thinking about that? And also just the global story on energy as well, because obviously China's been in the dumps and that's kept a lid on commodities. So yeah, how are you thinking about energy for the next little while here?
So yeah, we see China being really sluggish on energy. We see some other BRICS like Brazil trying to really control their inflation, and so they're kind of somewhat keeping a lid on it as well. Um, I think it's a noble goal to want to increase the U.S.'s output by 3 million barrels. I think it'll be challenging. And the reason for that is I think most of the current kind of like stagnation in U.S. oil output is more a matter of corporate decisions and then also well depletion rates, more so than just the Biden administration. So the Biden administration was actually more bark than bite on energy. So they had a lot of initially campaign targeting against hydrocarbons, but then when inflation hit, they were, their actions were actually not very aggressively against drilling. It was kind of it goes back to optics. A lot of it was optics rather than, like a company actually is going to want to do something and then they get blocked from it. Instead, back in the 2010s when the U.S. shale oil supply was ramping up, a lot of that was unprofitable drilling and there was a lot of external investment in oil and gas producers. Um, and a lot of them blew up because of that. Whereas the current time, we don't see a lot of external investment in oil and gas. And oil and gas companies are mostly drilling from their own profits. So every time they make a dollar, they decide, okay, do we want to pay dividends? Do we want to buy back shares? Do we want to pay off debt? or do we want to invest this back into the ground? And because OPEC has spare capacity and China demand is sluggish, they've not been super aggressive at wanting to put it back into the ground. And then shale has higher and higher kind of depletion rates year after year. And so it's kind of like the Red Queen syndrome, trying to maintain the current output, let alone increase it by another 3 million. I certainly think they could increase it. Three is a pretty aggressive goal. Um, Now, if you do really aggressive, like, tax incentives or something, like, if you really push it hard, it's possible. But merely, enabling more drilling and giving the industry more of, like, a 4-year green light on drilling and things like that, that alone is probably insufficient to get you 3 million barrels. Um, I don't really see acute energy shortages on the horizon currently. Um, but I do see just kind of gradually tightening, increasing. So if China decide to stimulate a little bit more, and as we see just ongoing well depletions, I think the industry is pretty much in balance. Could be erring toward tightness. And one of the interesting factors is if we do start increasing our export capacity, our natural gas prices could increase. So right now, oil is pretty fungible. It's relatively low cost to transport it around, whereas natural gas has a lot of limits for transporting it, given you either need a pipeline or you need expensive LNG export facilities and pipelines to bring it to them. And as we increase our potential, we could see a normalization where North American gas prices go up and then bring down gas prices to the places that we are exporting it to, which currently have much higher prices, which can't really be arbitraged because of that limited throughput in terms of exporting. So I don't really see energy-driven inflation as a key risk the next, call it, 2 years, unless there's some sort of major kinetic warfare thing that kind of brings oil offline. But it's something certainly worth watching.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. Today's episode is brought to you by Mantra Chain. Mantra Chain's mainnet has officially launched, marking a major milestone in their journey to become the go-to platform for tokenized real-world assets. Designed as a specialized real-world asset Layer 1 blockchain, Mantra Chain paves the way for traditional financial institutions to enter the Web3 space seamlessly and securely. With a high-performance infrastructure that can handle both permissionless and permissioned applications, Mantra is setting the standard as the home of real-world assets. Plus, they're making waves with big partnerships like their $500 million project with MAG Group and the new collaboration with Zan Bank in the UAE. Mantra Chain is all about building a compliant, scalable future for asset tokenization. Ready to explore the future of asset tokenization? Visit mantrachain.io to learn more and see how they're shaping the finance of tomorrow. I feel like a big theme that you're hitting on there is that if you just, subscribe to Econ 101 supply demand dynamics, there's very little incentive for oil producers to substantially increase their output there. As you mentioned, there's little incentive to reinvest that into the ground. So it feels like the only way, if they truly want to unlock and just flood the market with oil and get inflation, way down, they have to have some sort of non-market rationale to get producers to do that. And this is something I just thought about this morning, but perhaps one of those could be, hey, we're going to come in and refill the strategic petroleum reserve. That's going to be a marginal, non-market sensitive buyer. But I'm curious, yeah, do you agree with that framework? And is there any other of those like non-market incentives that you think might come online there?
I mean, I think that it's funny because they could balance themselves out if their goal is to lower energy prices, and therefore curtail inflation. But then they buy from the Strategic Petroleum Reserve to kind of offset that. You could get flat energy prices despite an
Yeah.
uptick in production. But they would at least say, okay, we refilled it. We're more prepared for an emergency than we were before. I do think in general we're going to see more non-market things. That's kind of a hallmark of fiscal dominance. I mean, even just the fact that deficits exceed net new bank loans in a given year, which is what we're experiencing now, but we did not experience usually outside of recessions in our lifetimes. Um, that alone is basically saying that the public authority is kind of redirecting resources on net, potentially even more than businesses and loan formation is. That's not the only variable to watch, but that's one. And as we kind of have now that you have tariffs involved, you have a lot of negotiations around global trade. I think just the government thumb is going to be in a lot of things, and so you have a more intertwining between investment outcomes and political tailwinds or headwinds. And I think that's going to be an ongoing hallmark of this whole period of time.
It's funny when you say that. That sounds like things that people attribute Trump a lot to being like the Reagan, Ronald Reagan 2.0, and just like absolute free market capitalism. But a lot of what we just talked about feels like it's actually not quite that. It's actually just a different form of government intervention in markets. Do you see that as like not the Reagan 2.0 that a lot of people are assuming?
To some extent, I think some certain areas get deregulated, but other areas are still directed pretty significantly. In some ways, we've seen a little bit of shift of the American political right to look a little bit more like the European political right, which is to say that there's a social conservatism movement there, but not as much of a fiscal conservatism movement. So in the 2010s, cutting the budget and keeping the budget constrained and cutting spending was a big kind of priority of the Republican Party, and we see just talking points a lot less about that, and especially in actions, kind of attempted legislation. So I do think it's a little bit more of a approach like that. Now, also interesting under Reagan, the part that would be comparable is that deficits did increase under Reagan. So prior to that, through multiple red and blue presidents, public debt to GDP in the US kept decreasing until around 1980. And then we started running bigger deficits and rising debt to GDP. And a lot of that was on defense spending. And that contributed to the outcome of the Cold War. So that's the actually ironically the part that's similar, which is you can talk about government reduction, but then if you're increasing the deficits, is it really government reduction? In a way it is, because if you're cutting certain regulations, if you're doing certain other things, you're kind of unleashing private sector businesses to varied degrees. That is reducing government. But in terms of actual numbers, that's actually where there's some similarities.
Okay, so I want to shift to how you're thinking about how the market is pricing on a lot of these major global shifts that we're talking about. So obviously, since the Fed first cut in September, and especially since the election, we've seen global bond yields blow out quite significantly across the board. At the same time, we've seen the U.S. dollar, the Dixie, go from 100 to 109. It feels like a lot of tariff concern, geopolitical concern, dollar wrecking ball concern got pricing quite significantly into the inauguration. We've seen U.S. bond yields come back a little bit here recently, but I'm just curious, comparing these big ideas that we've talked about with how the market is currently viewing it. How are you thinking about that tension right now in market pricing?
It's funny if you look at the prior Trump period, dollar rallied after the election and then generally sold off after the inauguration. So far, it's kind of repeating that pattern a little bit, but we'll see how it plays out. Um, a lot of it's going to probably come down to how aggressive the tariffs are. Um, and then a really big chunk of probably this whole thing is China because they're kind of running the opposite playbook of the U.S., which is that they're pretty reticent to do fiscal, um, and instead they're doing a lot of kind of monetary dovishness, which then translates to more currency strength on the dollar on a relative basis. We also have Europe kind of slowly melting, like in terms of economy and tech. They don't have they've lost a lot of their energy security. They don't really have the tech. We've seen gradual deindustrialization in Germany. Um, and that's a really big component of the dollar index. So when I look at kind of dollar wrecking ball, I'm looking at mainly like other currency pairs outside of the euro. So dollar to Chinese currency, dollar to Brazilian currency, and those are kind of levels that I'm watching. Um, and one of the factors of one of the things I kind of pointed out is that Structurally, trade deficits are part of how the current system works in the US. So they're not just like this thing that's kind of fixable on its own. It's part of a larger tapestry, which is if the US dollar is the global reserve currency, it basically means that the whole world needs dollars. Dollars are what they price a lot of international trade in, and it's what a lot of lenders lend to borrowers in when they're lending cross border. So even like a non-US firm, like if a French firm lends to a Brazilian firm, it'll often be in dollars and things like that. Um, and so, in order to have that whole world largely run on dollars, they need a lot of dollars. So the question is, how do they get so many dollars? And the answer is that the U.S. has run decades of structural trade deficits, and that's how those dollars flow out into the world. And the mechanism behind that is that compared to most other currencies, there's extra demand for the dollar. There's a monetary premium on it on top of other currencies that mostly trade on interest rate differentials, trade balance differentials, things like that. And so the dollar's kind of always perpetually overvalued in a way. And then therefore it boosts our import power and hurts our low margin export competitiveness, which especially hurts manufacturing and those kind of areas. And so dollars just kind of pour out into the world. If we start aggressively trying to shrink our trade deficit, we are indirectly saying that, okay, we're not going to supply as many dollars anymore. And so that creates a few different scenarios. One is the world, even though they have a lot of dollar denominated debt and a lot of liabilities for dollars, they also have a lot of dollar denominated assets. So they can sell some US assets to, service their liabilities. So you can get negative market functioning from too strong of a dollar. We've already seen around the margins foreign selling pressure on treasuries contributing to higher yields because of the strong dollar. And that can be like a negative feedback loop because now that yields are higher, it can further strengthen the dollar and therefore get more selling. Um, and that's why, generally speaking, when you start to get too strong of a dollar, uh, it's in the U.S. interest to try to curtail that. That's why they generally respond. They don't just say, "Well, it's your problem," and the answer is because it's not. It eventually ricochets back into U.S. markets. So if you're a president that cares about the stock market, or if you're the Fed kind of looking at like liquidity in the system, they do tend to take pretty strong, like pretty seriously when there's a really strong dollar. And I think that's another thing that's gonna be harder to tackle than expected. So kind of like how the fiscal deficit is harder to reduce than just talking about it. I think the trade deficit is going to be a much longer and tougher thing to do to reduce because it's inherently entrenched with the way the dollar system works globally.
So on that point of the explicitness, and does the US want lower dollar? Does other countries, try to want to strengthen their currencies? It feels like there's a lot of debate around how explicit this all is. There's, for example, you mentioned China about how their lack of fiscal stimulus, and there's speculation that perhaps one of the big reasons is because with the dollar so strong versus the yuan here, if they were to do that, it'd create substantial currency strains. And then you see there's talk about Trump potentially going to China and visiting Xi Jinping. I'm curious on your opinion on how explicit this whole, cross central bank agreement around currencies is. Do you think there's actual talks going on about, okay, we will lower the dollar and let China fiscally stimulate if, you take on these certain amount of tariffs, or whatever is the other side of that negotiation? How prevalent and explicit do you think those negotiations are?
I think that however prevalent they are now can probably increase under the Trump administration because he can make them prevalent. And I didn't know that like there's been interviews where Trump has talked pretty directly about relative currency strength um, pretty explicitly. And so I certainly think that that could be a negotiating tool. The U.S. Right now, the CNY is near the top of its range, meaning it's near the weaker end of its range against the dollar. Um, and both the U.S. and China, in some ways, have different reasons for not wanting that to break out. So China wants to increasingly internationalize their bond market. They want their currency to be seen as reliable for trade partners. And so they don't want a major devaluation relative to the dollar. And the dollar, if the U.S. wants to have more competitiveness on their imports, a weaker dollar can help with that. And so basically, it's you could say, look, I'm going to do a lot of tariffs and potentially mess up both of our economies, or let's come to the table and have, like some sort of 10 to 20% currency move. You can stimulate a little bit, weaken that will weaken the dollar relative to you. And, we'll do some optical tariffs that, keep the narrative alive, but don't really kind of disrupt things. And that could give you a little bit of a global economic boom. I mean, one of the ways to have kind of a strong global economy is cut the dollar by 10% because that means all these like dollar indebted areas have a little bit of easing on all their liabilities. So you can get strength out of Brazil, you can get strength out of China, strength out of a number of different areas. So I certainly think that that is like it. If I were in the administration, it's certainly something I would have on the table. So I can only imagine that they're considering these things as well. So I would assume that it'd be pretty prevalent.
Okay, the last major component to this whole journey we've been talking about here of what I feel like are potential landmines or moments of potential tension and major decisions that come to light is where Bitcoin might come into the fold of a lot of these dynamics. So there's obviously Trump has come in is very pro Bitcoin. There's talk and speculation about the strategic Bitcoin reserve. So I just want to ask you a twofold question. Is first, where do you see Bitcoin coming into any of those potential dynamics? And then specifically the idea of the US itself running a strategic Bitcoin reserve. Is there any, does that solve any of these potential landmines that we've been talking about? Does it help complement it? Or how are you just thinking about that within the context of what we've discussed?
So in the intermediate term, I think that Bitcoin is still too small to be super relevant for the things we're discussing here. At a 2 trillion market cap, it's probably still too small to really kind of enter these discussions. Um, uh, Now, if you so I any sort of decisions around strategic Bitcoin reserve are probably separately considered than trade for the most part. Um, and so, while that could be certainly beneficial, it's certainly beneficial for Bitcoin price. And if I was advising any entity, whether it's a corporation, whether it's a family, whether it's a country, it'd be like, yeah, you probably should have some Bitcoin. If your goal is to maximize whatever thing that you're running, owning more Bitcoin is probably going to benefit you in the long run. So we'll see how that goes. If we look out long enough, then things like Bitcoin and having a Bitcoin reserve can actually affect some of these trade dynamics because one of these solutions to having a structurally overvalued dollar and therefore a structural U.S. trade deficit, is to instead have more international contracts and more international reserve stored in neutral reserve assets. There's basically two methods. One is you either have a more multipolar currency world, so you say, okay, so some reserves are in dollars, others are in euros, others are in Chinese yuan, and a couple other major ones, or excess reserves and storage are kind of held in gold or Bitcoin. Um, and now the problem is that the current, the upcoming Treasury Secretary has specifically said that they want to keep the dollar as the global reserve currency. They want that sanctionability, and I think that's where there's some competition. You say, well, we want to reduce the trade deficits, even though the trade deficits are what supply the world with dollars to be the world reserve currency, but we also want to keep the reserve currency because we want to be able to sanction anyone we want, and those are kind of competing dynamics. Now, maybe, decades ago during the Cold War, it was more advantageous to have the global reserve currency than to not. But now that the negatives have kind of accumulated and are front and center in politics, in some ways, ironically, the downsides of being the primary reserve currency might be outweighing some of the benefits. It depends who you are. If you're the U.S. government, you want reserve currency because you want to be able to sanction anyone. If you're Wall Street, you probably want the world reserve currency. um, but if you're industry, you're kind of the one that's on the wrong side of this whole apparatus. And one of the solutions there is basically say, well, instead of all these countries storing excess savings in dollars, treasuries, and U.S. stocks, save them in gold or Bitcoin or other types of global assets. Um, but that's more of a conscious trade-off that I don't think this administration wants to make. The prior administration didn't want to make it. So I think it's probably a longer term process, and Bitcoin has to get much bigger before it really enters those types of discussions as a kind of a reserve asset at scale. Right now we see El Salvador holding it, we see the Kingdom of Bhutan holding it, potentially some Middle Eastern countries holding it. But in order for it to be like this, massive reserve holding among countries, I mean, at least has to get half as big or as big as gold. So basically, have to add another zero to the to market capitalization, and then it actually starts kind of being really relevant as potential alternative as like a large scale reserve asset.
Where do you see gold within that context? Because obviously, the one clear benefit it has over Bitcoin right now is its size and market cap and liquidity. Is that perhaps this short to medium term time horizon that you mentioned, where Bitcoin's too small for it? Where do you see gold fitting into that dynamic?
Well, I think gold's been benefiting the past few years because Bitcoin's too small. And so when these countries want to, around the margins, de-dollarize at the sovereign level, gold is their obvious choice for savings that they don't need to be very fast, right? So they can hold them long term. Um, the bigger Bitcoin gets, the more it starts to compete with gold potentially. Around the margins, I think it's already competed with gold a little bit, but actually, I see more indications that it's competed with silver, platinum, and gold miners. Because if you're a hard money enthusiast and you have a bunch of options for things you could previously invest in, it'd be gold, silver, platinum, the miners. Generally, if you want low volatility, you go with gold, and if you're more bullish, you want that higher volatility. If you're more of a trader mentality, or just want that kind of you're more bullish, you go with the higher vol things. But now with Bitcoin, it's higher volatility without the operational risks of being a gold miner or things like that. So I think that actually some of those higher vol hard money assets have been more directly impacted by the existence and growth of Bitcoin and to some extent the broader crypto space. Um, if you start to get bigger and bigger with Bitcoin, then potentially starts to challenge gold more directly. Um, Probably not for quite a while. And then even in that scenario, kind of like how gold is always like seen as like the hedge against some sort of major economic issue, you could see gold as like the hedge against some sort of major cyber attack or something. People, there still be entities around the world that say we want to have some analog wealth stored rather than, put every single thing on this network. Um, so that it certainly still could be seen as like a backup option and just a different type of backup. So I still think that compared to the global bond market, gold can still grow into that, even as Bitcoin is on its flank, kind of growing into gold to some extent.
Okay, so just to finalize here, setting aside, potential idiosyncratic positive headline events like a Bitcoin reserve or whatever, do you see the global macro picture as being generally positive for the next 12 months for Bitcoin and gold like it has been for the past year or so?
Yeah, I incline in that direction. So the biggest things I would watch, one is global liquidity. Now the potential risks to global liquidity are tariffs or anything that would spike the dollar. But that's offset by the fact that we have a president that generally wants higher asset prices, that would generally not want a super strong dollar because he would perceive it as going against his trade policies, and you would potentially even label certain other countries as currency manipulators if they let their currency weaken too much relative to the dollar. So these with some bumps in the road, I expect decent liquidity this year, which probably is supportive of Bitcoin and gold. And then I also look at things like kind of Bitcoin's own metrics. So when I look at, say, market value compared to on-chain cost basis, so market value versus realized value, I like to look at those types of ratios to see kind of how euphoric is the network. And so far, it looks nothing like prior major multi-year tops. It looks kind of middling in the road in terms of that metric. Similarly, when I look at, whenever there's a major bull run, there's like the hodl wave. So how what percentage of coins haven't moved in over a year? And when you get a major bull run, that number starts to dip because you have a number of long-term holders that are up 5x or 10x, 20x in their position, and they start trimming into that strength, and new buyers are buying into that strength, and that eventually can exhaust new buyers. And the rotation we've seen is still smaller than prior major cycle tops. So when I look at in the Bitcoin space, it looks like that still has room to run, and then I generally expect both politically now there's some green lights on it, and then also liquidity wise, uh, while there's potentially some bumps in the road, I don't really see like a major negative turn in liquidity, and therefore I generally expect that we probably will see higher highs in Bitcoin this year.
Well, look, Lynn, always great to get you on the show here. Much appreciated. If folks have somehow not read your work and seen it before, where can they go?
They can go to lynalden.com, or they can see on Twitter at Lyn Alden Contact, or they can check out my book Broken Money.
Awesome. All right. Thanks, Lynn, again.
Thanks.